Tesla Inc. is sparking concerns around job security.
This is not financial advice, silly.
Robot just stole my job. I'm there like, oh my god. I blame it on Elon. He's taking all I got. Turned up to work and went to start my day. Was barely late, like 9:08. So took my coffee break. Then I got hungry, so I just stopped by the free buffet. But then to my dismay, I heard somebody say, "Attention humans, you have lost, you have not met your quota. Pack your belongings in a box, now it's over." Robot just stole my job. I'm there like, oh my god. I blame it on Elon. He's taking all I got. But I'm in management. I work hard every day. I need these benefits, health and 401k. How could they do this shit though? Where will I trade my crypto? I had a second monitor for Twitter, where will it go? Somebody please stop the bus. I mean, not the fuss, but there's lots of us. And now you say you won't pay me to play ping pong because Optimus. I mean, who employs an end humanoid? Some new droid for you to exploit, deploy to destroy your human droid. No lunch breaks, great, get a few deployed. Your time is up, human inferior to me. I'll take it from here, you're relieved of your duty. Robot just stole my job. I'm there like, oh my god. I blame it on Elon. He's taking all I got. Robot just stole my job. I'm there like, oh my god. I blame it on Elon. He's taking all I got. It's okay, human, please don't cry. You can always go and become a Twitter thread guy. Make pretty pictures with Midjourney on your new PC. Or make some YouTube videos about ChatGPT. Sucker. Robot just stole my job. I'm there like, oh my god. I blame it on Elon. He's taking all I got. Robot just stole my job. I'm there like, oh my god. I blame it on Elon. He's taking all I got. I mean, I didn't even write these songs. I just used ChatGPT because it's way easier. Holy shit. We are so doomed. Robot just stole my job. Robot just stole.
Yo, yo, yo. I can't wait. In the future, I'm going to have something called the Stream Deck set up. It looks like this. And then I'll be able to have everything programmed and just a lot slicker. It's going to be really cool. You can program all the buttons. You can get them to perform all kinds of operations. So that's on my agenda here soon. But anyway, you didn't come here for that. You came here to talk about investing. And let's take a look at the portfolio here. It looks like it says down 31 here, but it's probably more like 15 to 20 across all the accounts since I've got a decent amount of crypto and others. The big losers today, in my account at least, were PayPal and Tesla. Tesla, of course, continuing to take a beating. It actually closed about half the gap at the 145 range. It got real, real close. So maybe we go down again tomorrow. But I think we're getting very, very close to the bottom. If nothing else, I'm actually starting to think that Tesla might be a buy the news event come earnings if we keep dropping the way we're dropping. And I'm still optimistic on markets, and I'll show you why here in a little bit. PayPal, again, taking a hit on this one, but the stuff that's bleeding is really my short-term January 2025s with a 140 strike. It's getting so far out from that number right now, and then with a limited amount of time, the theta decay is just brutal. So those are down 61%, whereas my others are still up 4.5%. So that shows you the difference that time can make, right? When you start to get really far away from the strike and you have less time, it can be very painful. So just remember this, the good and the bad lessons are very important for you to absorb. You're not always going to be right. It's why you have to have portion sizes that divvy up amongst different investments. It's why I've got so many different asymmetric bets. I mean, ARKG, Cypher, CleanSpark, DLO, ETH, Flux, Hood, MicroStrategy, Matterport, PayPal, SoFi, Square, and Tesla. Square is really tiny, though. Maybe we don't count that one. And then on top of that, I have a bunch of shitcoins because some of my highest conviction bets over the next year for performance are going to be Bitcoin related. So that's why I'm so deep into that one. So you just got to remember stuff like this when you're thinking about your investments. Today, obviously, Cypher, CleanSpark, MicroStrategy, they were the big winners. Bitcoin related stuff were the big winners. Saved my portfolio, made it to where I only lost about 15 to 20, which is not a lot for me. So very, very happy about that. Again, Coinbase portfolio actually up today. It was like at 234, 235 yesterday. So that's dragging my average up for the day. And then looking at the stock heat map, it's kind of a mixed bag of nuts, man. It's like every every category you look at pretty much has combinations of red and green, with electronic technology outside of like Nvidia and AMD really getting crushed. I think a lot of these though are like just rode the AI train, a lot of the chips sector, and I think the only ones that might really benefit in the future are probably going to be Nvidia and AMD, unless some of these others can come up with something to compete, and it's still arguable on whether or not AMD has that. But outside of that, outside of this just kind of being all red, everything else was a little bit mixed. Binance did okay, but then companies like PayPal did not do very well at all. And then again, Tesla just brutally red when compared to everything else. Now, again, crypto markets, not so much. It was actually a pretty good day for crypto. You look at the daily here. I mean, Ethereum up 2.66, Bitcoin up 3.41, and Solana doing really great. This is probably why my bags and my crypto are doing so much better today. This is a key factor right here. I think Solana is going to bounce hard. You got to remember with Solana, it was in the 200s, and now it's 139. So some of these cryptos, and this hasn't even been beat up as some of them. Some of them have really taken a hit. And I want to say this because I think it's important for people to understand. Crypto and Bitcoin related investments are higher beta right now, right? Like they're higher beta all the time, but they move usually first. We started to drop in Bitcoin before we started dropping in the stock market back in like, what was it, 2021, 2022, right around that range. And we hit the bottom in Bitcoin earlier, and we went up hard, way ahead of the stock market, and then we tabled off for a while. And we're just always a little bit ahead. And so what you have to realize is today we're seeing, and yesterday we were seeing the bottoming signals. I was talking about them, and I even called it. I said we're looking like a bull flag on Bitcoin, and I think that's happened. And I actually want to show real quick before we get too far down the rabbit hole. I do want to show Bitcoin real quick because I think it's important to look at that one and just the strength that it's putting off. And then companies like CleanSpark, we're definitely looking at miners today, guys. Just doing really good. Now, here's what I wanted to show you, right? If we remove some of this stuff and we just look at the weekly chart for Bitcoin, look at all these wicks. Look at all these wicks. Not a lot of wicks to the upside, just two, right? Two big ones, really. But to the downside, it's like 6. So 2 to 6. So you can see this thing tried to test down a bunch of times, and it just doesn't happen. It just keeps wanting to go higher at the weekly close. And then we've got volume here. If we can maintain above that, if we can maintain like roughly where we are now or even higher, preferably, then this is going to start to look really good. And one of the things I wanted to point out here, if I draw this back here, we look at our pink lines, and I posted about this a few times, but if I draw this out like this, it really starts to look like a bull flag. This was a bull flag. This is a very clean flag. Didn't even dip down. But this looks beautiful. And again, this is what it looks like when it's scary. This is like when you got a bullish price action, but then you have RSI, MACD pulling you low, and then you get a big drop. But what we're looking at up here does not scream like we're going a lot lower. And it moves first. So if Bitcoin's telling us that the market's probably bottomed, we probably bottomed. And I've got more to show that I think is going to be very exciting in that regard. So we'll look at that in a second. Just in regard to a potential bottoming signs. Now, I told you for a while now the S&P could still drop. It's still dropping. I've got to readjust some of this, though, because it's getting closer to my low-end targets. Even though I think with the S&P, I think our likely bottoming zone, maybe this week, maybe it happens Friday, maybe it happens tomorrow. I don't know. But I really think the 100 is probably going to act as a potential support zone. And that's only like 1.58% lower than what it is right now. So if that turns out to be true and we can find support off of it and then go higher, I think it's going to be a very bullish sign. Also, let me make sure I save these too. When I get done drawing, I got to save these things. All right. Also, the NASDAQ bled out pretty good. 0.57. So again, it was a higher vol versus the S&P. Now, it already got to the 100, so we'll see if it can find support. The NASDAQ, though, seems like it can go lower because we have very little volume level support until we get to like the 17,000 17,000 range. That's where we really start to find support on the NASDAQ. So 17 support over there, and then maybe for the S&P, it's not until 49.30, or maybe we find it at 5,000. We couldn't get under it today. We'll see. Now, the Russell, I told you we'd find some support at the 200. We did. The weekly 200 is a heavy level of support right now. I'm going to have to drag this down, though, because the next level of support. So if we really bleed out, we're going to find ultimate support on the 100 moving average, I believe, and that's about 3.86% lower. But we'll see. This could be it. This is a good bounce zone. I think for all of these, like, we're in a make or break zone, and I think this is where we start to see bounce. And I'll show you in a little bit why. From a few perspectives. One, real quickly, the MOVE index. So this helps. This is less pressure. The dollar still went up today, but at least bond volatility didn't go up. As you can see here, we rejected off the 200. We're still sitting above here. I think this is the 100. I got to change the color. But we rejected off the 200. Hopefully we can drop underneath this too, and we can start to see bond volatility tapering off as long as we don't have any major geopolitical issues. This won't necessarily send stocks up because a strong dollar can still be a problem, but it at least lets us know that people probably aren't surging into bonds, which is what we want, right? We don't want to see people running towards bonds because then they're probably not going to stocks. So this is one less thing, or it's one more thing that looks like it's going to start tapering off, and that's a good sign. Oil going down is also a good sign. We like that. We don't hate it. You can see where we broke down again from this descending triangle, and where I'd marked initial like resistance in a light red, and then a deeper red for like really strong resistance, right? And we rejected out of that, and now we're back down here testing the moving averages, and I think we could still go down to the 50 here soon, and maybe even the 200 before we start to try and test support. And that would get us on the daily time frame closer to oversold conditions. Actually, the bottom of this range would get us at oversolds if we hit this green line. So it'll be interesting to see what happens there, to see if it turns into support again. But I do think that this is going to chop for a bit, barring some major geopolitical endeavor. So look towards Iran and Israel. And there's still a lot going on there. And nobody's talking about it anymore. Like attacks, killing major generals of the Iranian regime, and the Iranians trying to get dirty bombs, all the stuff. Nobody cares. Nobody cares anymore. We'll see if it becomes a headline again. Mainstream media will let us know if it matters, guys. But anyway, that's sarcasm. The dollar up 0.28%. Again, I said it could meander in this range, but I don't think it's going up in a big way. If it does keep going up, it's just indicating more future pain for a lot of sectors, right? Because if the dollar keeps gaining strength, you're going to see everybody who has international business losing revenues. So if you get a lot of business internationally, like a Starbucks or an Apple, or, I mean, Tesla still gets a decent amount, right? Like over 35%. So if you get a lot of international business, it's going to create downward pressure on your stock, which is going to be important. So we don't want to see the dollar go up. Very, very important that it goes down. I can't believe this is happening. In one day, tomorrow night, the Bitcoin halving is going to occur. I'm not sure if I'm going to do a live stream for that or not. I might throw out a vote here real quick. Let me see. I haven't done one of these in a while. Should I do a Bitcoin halving stream? I don't know how exciting this will be. No. Whatever. All right, I'm going to start polling. There's a poll. Let me know if I should. All right. But yeah, that's going to be happening tomorrow night, which is just nuts. So from my experience, I can tell you, going through a few of these now, it's pretty much just a bunch of people talking about the Bitcoin and why it's going to do great and why the halving is impactful. And you're counting it down and you're counting it down and you're counting it down. And then it happens. And then it's like, okay, guys, I'm going home. So that's pretty much what's going to happen. And again, we could talk about all kinds of stuff. Maybe we can pull up other streams too and see what other people are doing, but and comment on it. But you guys let me know what you want to do. All right, liquidation map. I wanted to show this again. I showed it a little bit yesterday, but this is the Bitcoin liquidation levels, and I went out 3 months for this. And it's in regard to perpetual contracts. So this isn't like option stuff. This is like people using leverage to go long or go short. So like 2x, 3x, 5x. I mean, there's stupid amounts, like 50x on some of these exchanges. It's just nuts. It's insane. It takes like 2 seconds to get liquidated and lose everything you have. But as you can see, I said this the other day. I think James was pretty much voicing the same message from Invest Answers, that liquidation levels were down in the 57, 58 range. And we liquidated all the longs down in that range. I mean, there's just a few people that were lower, right? They haven't been liquidated yet. But here's the thing. Bright yellow indicates, like the brighter this gets, the less purple it gets, indicates the amount of money that's sitting there waiting to get liquidated. Bitcoin would have to drop down to under 51,000 for there to be a wall of liquidations. And that is really hard to do when you don't have any longs to liquidate to get all the way down to that level. And I don't see where Bitcoin does that. It doesn't make any sense. And again, just looking at the chart and seeing the strength that Bitcoin has and the wicks that are going up and knowing all the inflows and knowing the ETFs and knowing just all these things that are going to act as positive towards the price action, I don't see how we get lower. So if we can't get lower, we're going higher. And again, the miners are actually a great representation of that because they started moving up yesterday, right? Before Bitcoin really even started to move. And then Bitcoin goes next, and then stocks go next. And we'll talk about that in a little bit. But again, I'm seeing a buy the news event, I think, with the halving, or at least just chop to sideways. Like maybe we bounce down, up, down, maybe up, down a little bit, and then eventually we just break out. Because again, I think it's going to take about 3 to 4 months based upon my projections of just each cycle from the second, third, fourth for the halvings, technically the fifth epoch, but whatever. It just shows that it takes less time for miners to get back to their previous levels of income, which is important. Now, Marty Party posted this one too. I wanted to share it. It says 6 billion of shorts to liquidate with a move to 72,000 on Bitcoin. Can you squeeze to 108K? So what he's saying is when we do get to $72,000 Bitcoin, which I don't think is that far off, worst case, maybe 2-3 months, right? And this thing just explodes. Worst case, it can happen sooner. Now, if that happens, we will liquidate almost $6 billion in shorts. And he's saying, hey, I think with that, we could have just a massive push higher to 104-ish, whatever. I don't know if it'll break 100. That's usually like a massive psychological level. It's like the 20,000 in the 2017 range. It's like breaking 70 in the 2020, whatever. I can't remember these dates anymore. But it's like hitting these levels and then you just get stopped out. So I think temporarily that 92 where the fib is and to the 100 range, 92 being the golden fib, I think that's where we kind of top out. But I do agree with him that there's so much open interest to the upside when these guys get liquidated. If you're new to this, it's called a God candle, and there is a reason they call that, because you're just sitting there praying and smiling and about the happiest you've ever been in your life as you watch your portfolio expand at a rate that does not seem possible. So when it comes, you're not going to hate it. You're not going to hate it. All right, poll finished. 74% say yes, 17% whatever, 8% no. I think we're going to go. I think we're going for it. That's enough for me. Worst case, we can hop on other people's streams or invite somebody on. We can figure it out. CME, I want to talk about this. I've got a video I want to show you guys too. It's a short one. It's really good. It's from BlackRock. Not Larry Fink, but a brilliant man who I need to introduce you to if you haven't already met him. Now, there's only a 19% chance of a rate lowering in June. Looks very far away. Unless data starts helping that cause. Today's data certainly didn't. We'll talk about that in a second. But now, even July only has like a 42% chance. So, that's a ways away. Hey, Jesse, have you heard or looked into DXYZ ETF launched a few weeks ago? From what I've heard, that's incredibly overvalued versus its premium. And so you might have made 300% week, so I sold. Now I want back in. I wouldn't get back in. You need to understand what you're invested in and what their net asset values are, their NAV. from what I read, and I think I've got something I can pull up here in a little bit and show it to you, is that it's incredibly overvalued right now, and it's not a good deal at all. So that's what I read. So check that before you think about getting back in, because it could drop, if that's true, if it's like overvalued by hundreds of percent, and it's running on that kind of premium, it could drop 60% and still not actually be the value of its underlying holdings. And that kind of stuff just sucks, guys. It's just like the Solana shit I was talking about the other day. Stay away from that stuff. Real quickly, though, back to this Fed watch tool. So it's really saying now we're not getting a rate cut until September. I don't think that's true. I still think it's June or July. I'm going to die on this fucking hill. I will die here. Unless the data just literally overrules me in the next 2 months. I don't see it. I don't see it. We're still getting deflation exported from China. Their data is horrific. Tonight, we're going to be looking at their economic data, and we're going to see foreign direct investment, and I'm willing to bet it's just as big of a shit show as everything else. There's so much pain. James Crawford, DXYZ has about $4 to $5 shares of holdings, trades at a premium. 7 to 8x? Are you serious? It's a 7 to 8x premium. Fuck that, dude. If you made 300% on that, Kalen, don't go back. Don't go back, please to God. Yeah, thanks, James. Yeah, I thought it was 2 to 300. If it's that high, Jesus. Yeah, stay away from that. You will get royally fucked. All right, so real quick here, we're gonna jump in. Because I want to hear this conversation. I forget his name. He's brilliant. He's from BlackRock. He's a very smart guy, and he's going to talk about why he thinks rates do need to come down sooner than later. So I want you to hear that, because I think it's pretty well versed. He talks about, well, you know what? I'll just let him do it. 1 second. Let's go.
Argument that, whereas we once thought we quote unquote needed rate cuts, that we don't necessarily need them in the way that the economy is responding now?
So I think the Fed should cut rates, and the reason why I think they should cut rates is because what happens is much of the U.S. economy today is not interest rate sensitive. You think about who spends on R&D today. We have a digital economy, service economy. The R&D spend is not financed like it used to be. It's often financed through free cash flow. You have many people have already locked in their rates. Companies have already termed out their debt. It's not that interest rate sensitive. What is interest rate sensitive? Low income, small banks, small business, real estate. And so what's happening, you create a...
All right, let's just hold on here. So he's saying that, guys, you're not restricting inflation the way you think you might be restricting inflation. What you're doing is fucking poor people. You're fucking small businesses that are rate sensitive. You're fucking the real estate market, the auto sector. All these kind of things are being detrimentally hurt. And again, like the commercial real estate market is going to get hurt. So you're causing a lot of pain and suffering, potentially in like the bottom 35 to 50% of the population is having more of this pain in varying degrees. And at the same time, you're hurting small business. Small business is the economic engine of this country. And he's saying like you're not helping. In a second here, he's going to talk about the service side versus commodity-based portions of inflation. So it just boils down to these high rates are causing more pain than what they're helping in regard to inflation, is the point he's going to make. And I totally agree with that. But let's hear the rest of his dialogue.
Pernicious impact on parts of the economy, and it's not really influencing the other. And then arguably, for higher income, for a lot of the economy, when you keep rate this high, you're providing a lot of income. Deposits at our...
So he's right. Think about this. You're still, housing prices are still going up. So the top 63% that hold mortgages, they're getting wealthier. Stocks, at least over this last year, again, I made 700% last year. That didn't exactly make me poorer, right? Not everybody did that well, but if you were rich, if you're uber rich, you just park the shit in bonds. If you got $10 million in there, I mean, you're making 5% off of that. So you're just literally making the upper end wealthier and providing them with more ability to spend. And part of that, I think, goes to the service sector. The rich go to like a high-end restaurant and do other things, and they spend on wealthier goods, at least in this country. You're seeing a lot of that. But at the same time, you got poor people that are just royally fucked don't have any assets at all. Their pay hasn't went up by as much as the inflation has went up on the cost of goods. And so you have this really wicked imbalance you're creating by the rates staying high. And then there's also conversations about real estate and how higher rates are actually making it to where the housing market is staying high because it's not freeing up existing homes, which used to be the highest number of sales, right? Existing homes used to be like 2-to-1, 3-to-1 versus new, but now all the home sales are new homes. So you have this problem where you're not freeing up the housing sector. The auto sector is like everything is fucked, and you're creating artificial wealth at the top, and then you're fucking everybody underneath, including the small business sector and including areas that are sensitive towards high rates, like Tesla and others. And so it's like you're destroying parts of our economy, not really doing anything to bring down inflation, because in some cases you're creating more inflation because with the real estate going up, rental prices end up going up because the taxes have went up, the insurances went up, the mortgages are higher on the properties that are getting built. And so you're having to charge people more for that. And then you have illegal immigration where you have like 8 million people that came in under the Biden administration, maybe higher than that now. You got to house these people, but you don't have enough houses, and the existing home market is frozen. So it's like you're creating inflation, if anything, or not helping at all with these higher rates. And you're creating these weird imbalances. And I think that's very important to understand. And let's let him finish his thought because he's brilliant. Ryder is brilliant. I can't remember his first name. I needed to jot it down. I need to see if I could find him on X.
Extraordinarily high levels. What's happening is you're getting a lot of income flow through the system that recycles into parts of the service economy. So listen, I think if you got the rate down to still what is a restrictive level, then you have what is a more normalized economy or more normalized discount rate for this economy. Listen, I don't think they're going to do it, though, until you start to get those 0.2s. But I think unequivocally they should get there.
The longer they wait, do you fear that it increases the risk that they make a mistake and stay too high for too long? And by the time they react to something that gets broken, it's too late?
So
Yes.
It's a tough question. I'll say it in two parts. One, I think the U.S. economy is the most resilient, adaptive, innovative economy in the world. I think U.S. economy is much more durable. Think about, it was on your show a year ago, people were saying hard landing or soft landing, what kind of landing? The U.S. economy, we have a service economy that's this adaptive, by the way, has an energy dynamic that's very different than 20, 30 years ago in terms of energy independence. Very, very reflexive, adaptive economy that I'm not that worried about the broad economy. The mistake that I think is the reason why I think you could move the rate down, the mistake is the areas that are sensitive, the banks, particularly small regional banks, that clearly have an issue in terms of net interest margin, commercial real estate exposure, small business, and lower income. You're seeing this in all the earnings numbers, and you see this in credit card charge-offs, loan delinquencies, auto loan delinquencies. It's creating a pernicious effect on part of the economy that in aggregate, the economy can still move along okay, but it's creating too much pressure on part of it. And that's the mistake that I think is out there, including you got to be careful about residential real estate, which is obviously a huge part of the wealth in this country. So part of why I think at the margin, bring that rate down. You can keep it higher than it historically has been, but I think today it's for a lot of the economy, or for interest-sensitive parts of the economy, it's the rate is too tight.
I 100% agree. It's like you're damaging part of your economy. You're not necessarily getting the results you want. And LB, you just asked, don't they have to keep rates high to prevent housing from continuing to go up in price for younger generations? No, it's the exact opposite. It's the exact opposite. Housing prices are going up because there isn't enough supply. Normally, the majority of the supply is the existing home market. The existing home market is frozen. It's at levels that are like 30-year lows. So what would normally be the majority of the sales and that would keep the market remaining fluid and allow prices to go down because people can start buying houses and the new guys can, get into more. See, here's the thing. New home builders are doing fucking great. D.R. Horton just reported earnings. They're making tons of money because since there's no existing homes to sell, and that used to be the vast majority of the market, they can just build homes and keep charging more. But if the existing home sales started to come online, you'd open up inventory that's remained trapped for a while. And you have a lot of rental apartment places too, but you want rates to come down because then these companies that are doing the building too aren't passing on higher costs. Because right now the rates are high, the taxes are high, the properties are like everything is higher than it normally would be. They're just going to pass that on when they sell the places. And then again, they do that with CRE, they do that with apartment complexes too. It's just like residential real estate. And so all this stuff, people that are renting are going to end up paying more again, and it doesn't make any fucking sense. It's a mess. We want rates to come down. We want to open up the market because then as the market opens up, you could get downward price pressure because you have more housing available. And at the same time, you would have the overall costs go down because the rates are lower. So if you want to help inflation, we need to bring the fucking rates down. It's not an issue with there's just no availability in the homes. That's the problem. There's no availability because you can't sell any. Nobody will sell their fucking home when they have a rate that's 2 or 3% and rates are in the 7s. They need to get down to like 6. If we lowered rates one time, we could probably get sub 6 in the mortgage sector. And then people are like, "Oh, hey, maybe it's okay now for me to sell. Maybe it's okay because now we got a signal that rates are coming down. I'll just refinance it in a couple of years." But you can't get that kind of movement if you don't fucking do it. And again, we're crushing small banks, regional banks. We're crushing, real estate. We're crushing the auto sector. We're crushing other interest rate sensitive businesses, and we're crushing the poor in our country right now. And it doesn't make any fucking sense because at the same time, we're crushing our government with debt and interest levels that we can't afford to pay in the future. So when we're issuing these bonds and these treasuries, we're doing it at rates that just aren't good. We need to lower rates to make our debt more sustainable as a government too. So it's very important that we start lowering rates in the future because I don't think we're getting a benefit on lowering inflation. And I still don't believe inflation is our primary concern. I get that we fell really hard and then we started to peter out, and then we started bouncing back a little bit in some areas. But that's not what we're seeing in oil today. And that's not, when I look at a lot of commodities still, and I look at a lot of this data, sure, we bounced a little bit, but it could just still roll over. And that's what's happened in China. China, I think, is a leading indicator of what we have to fear. China bounced and then just fell off a fucking cliff. Let's jump back to this in a second. I got to show, look at this. United States, existing home sales. Look at the level we're at. We're down here. We sold some. Cool. Prices are going up still. We sold some, but we were at levels that we saw in 2010, lower than what we had in 2009. And then if you go back here, it's the 90s. It's the 90s. So we need to free this up desperately. We need to have home sales starting to pick up. And again, if I look at China-related data, let me just go back here. Let me see if I even have it from this week. Let's look. GDP growth rate, bullshit. Fuck that. Let's look. Industrial production. This is actually a lever that China uses to try and push basically their way of helping fund everything. And let's just look here. So China, again, had a massive swing up after the pandemic. They did really good. Everything was looking great. They went back down. They bounced up. Now they're starting to roll over again. It's kind of hard unless we zoom in closer here. But they started to have kind of like the same thing we did. And if you look at other metrics with them, it looks the same. They started going up and then they're rolling over. And their economy is much worse than us. But they are the second largest economy in the world. Japan is the third largest economy in the world. And we're applying pressure on their yen that goes back to the 80s almost. So like if we're crushing the second and third largest economies in the world are getting crushed because of us and our high rates and their own underlying problems, inflation isn't our biggest issue. It's just not. I just want to reiterate that. And we're going to go back and look at more of this. Let's let Ryder finish his conversation, though.
You called the recent inflation prints a quote-unquote setback. It sounds to me like your view is a bit shaken by those most recent reports, that you were surprised, and I'm wondering if in the same light you're surprised to the degree that rates have backed up now.
So I would say two parts of that. One, we're running our interest rate exposure. We have been running our interest rate exposure lighter because, quite frankly, you can generate income and fixed income in so many different ways. You don't have to take long end interest rate exposure. I was looking at the aggregate index. Today, the aggregate index is down. After today, it'll be down 3.5%. The long end of the curve will be down about 8%. The front end, because of the carry in the front end, is still actually, the front end is actually moderately positive on the year, total return basis, because you're carrying so well. So anyway, our view has always been, certainly this year, keep your yield, keep your income in the front end, just carry really well. You can actually still throw off return in that. That being said, your question about, listen, when you got this last CPI report and you looked at the areas, the pervasiveness of the service level inflation, insurance, healthcare, education, transportation services, that is just so sticky high, and hard to bring down auto insurance using the interest rate tool, and those are sticky, and they're just hard to bring down. And so, listen, I think
They're
anybody
slow.
who's looking at it would say, yes, that's a setback because we want to get, and the Fed would like to get rate down, but it's these numbers, can you be a bit more patient?
All right, I just got to say this again. The reason we need to get rates down is to help inflation. I'm just going to keep saying that over and over again. Some of the stickiest components that we're looking at right now are basically taking away from spending power and at the same time kind of crushing different parts of the market are things like taxes and insurance. One of the stickiest parts, one of the biggest parts of the last CPI read was in car insurance. And the car insurance is more because the car prices went up 40, 50 fucking percent because of the pandemic. But they're slowly starting to come back down now as we've got a glut across the entire auto sector. So those things will drop in the future, but they'll be slow. If that's what we're fucking waiting for, we're screwed. If we're waiting for, real estate taxes and insurance and auto insurance to come down, we're screwed, because those are very slow moving mechanisms that are less likely to actually be brought down and more likely just to kind of be the new norm, right? And so it could take a year before those things really start to roll over and look more positive. We don't have that amount of time. Our employment market isn't that great. Again, we've lost about 1.5 million jobs, and we've gained a bunch of part-time jobs. That doesn't mean scream healthy economy. Might make the unemployment number look all right, but it doesn't scream healthy economy in a healthy employment sector. And I just think that, again, these high rates are actually making rich people richer and causing strength in the service sector, which is the last thing we want. We want everybody to do well. We want the poor to do well too, right? We want to stop crushing them. We want to make their loans, which are already normally really high because of bad credit, sustainable so that they don't get crushed and thrown out on the street. You think homelessness is a problem right now? Fuck the bottom 1/3 of the country for another 6 months to a year and give them even more pain. Have them lose their jobs while their interest rates on their loans are outrageous, whether it be housing or auto, and then see how things look in your local city. See how much the police force needs to be expanded as you fuck these people. But yeah, so my vote is still and will be for a while that rates need to come down, and I hope we do it in time. That's my big thing. I hope we do it in time. Hope we do it in time for the markets, not just my portfolio though, just for our country. And this guy's saying the same thing.
It seems like it.
Yeah, I mean, some are suggesting that the 10-year could go to 5% by Memorial Day. That's been a couple of calls from firms this week. When you read that, what's your reaction?
Given the depth of some of these markets, it feels like that could happen. You don't need to wait that long. Listen, it's going to have a lot to do. We're in a market today, and I think when we think about positioning, and you think about we're in a market today, you got geopolitical risk, and think about that can happen two different ways. It can shock oil, which is adverse to interest rates, and the other side of it is you got to have a big flight to quality, depending on how pervasive or how the risk is perceived around the Mideast. Listen, I think the markets tend to overshoot. And could the bias be towards you hit a higher rate from where it's not that far from where we are today? Mm-hmm. It's certainly a possibility. Like I say, I think the way you sit in fixed income today, stay shorter on the yield curve, and you keep your interest rate exposure and low, but keep your income high. By the way, I want to say one last thing about it. I'm always amazed the equity market. Like there's always a level on the 10-year note that determines a good market or not a good market. When you look at the S&P 500, it's not nearly as interest rate sensitive it used to be. The interest rate is obviously the great discounting rate for the markets. But it's a very different, you look at the S&P 500 versus 20, 30 years ago, where those companies borrowed, hard asset borrowed to finance. The interest rate was a really big deal. Today, we look at the top 7, the Mag 7, or any of these companies, they're not doing a lot of financing. So I'd argue it's much less acute for the equity market than it's been historically. Although people follow it very closely, it's just not nearly as interest rate sensitive, the equity.
So that's an interesting take. I haven't watched this full thing yet. I wanted to see it. I knew I wanted to talk about it, but he's saying that especially with all these large caps, they're so powerful nowadays. Back in the day, they couldn't just borrow and keep expanding and keep doing all this stuff, focusing on AI, focusing on autonomy, getting rid of jobs, trying to gain more business and more market share, just having tens of billions of dollars in bonds that are earning interest, if nothing else, just generating more cash. They don't have to borrow. A lot of these big companies, they're so cash rich that they're just not rate sensitive like they used to be years ago. And so I think he's just saying like the playbook the Fed is playing with and the reality of the equity markets and into just these different sectors is just not the same as what it used to be. And with service being such, like everybody thought that commodities were going to be the major issue. And again, they're ticking up a little bit now, but they're just not the issue. Even we've got 2 major wars going on in the world right now, potentially a third front that could open up, and we can't even get oil to $100. So the commodity inflation just isn't the problem this time. It's the service-based, it's the rich people who are just going to keep getting richer. The higher the rates stay, especially like the uber rich, right? Like not even necessarily people like me, the people that have like 10 million, 20 million, 100 million, billions of dollars, they're just getting filthy rich off of this shit. Because if nothing, inflation is slowing down. And at the same time, they're still getting interest off of it, and they're still getting their assets going up, and their properties getting even more expensive. It's just stupid.
Market as it used to be.
I hear you then suggesting that your bullish view on the equity market, which you've shared with me on the last couple of times that we've visited here on television, is not shaken at all by this backup in rates. Do I hear that right?
You definitely hear that right. Listen, I think, we like others, you've got to manage, when you've got this big unpredictable dynamic out there, i.e. geopolitical, I think you got to manage your risk alongside of it, including going into this, volatility was incredibly low. Where the VIX was, we trade a lot of equity options. Volatility is really low. You could manage your risk using volatility really effectively. And so that allows you to de-risk. So we are running less risk, considerably less risk, largely because of volatility and because of some positioning around that. Listen, the equity market's going higher. So do we wait a little bit in terms of getting through this cloud over the market? The S&P 500, I use this stat a lot. The return on equity, the average return on equity of the S&P 500 is 18.5%. And actually, if you're tilted more to tech, it's closer to 20. Even if you believe the multiple is a turn or two too high, when you accrete, you compound book value of that sort of level. And even if the economy moderates a bit and you bring it down a little bit, that is incredibly powerful. At the same time, there's over $1 trillion of equity buyback, and the IPO calendar is small. So your demand, your buy versus sell, is clearly skewed, and then just normal salary and wealth creation drifts into the equity market, and you've got $8 to $9 trillion of cash sitting out there. So yes, I think I'm pretty confident equities are going higher. This is not to say we see.
God, he's got so many good points there. So many good points. I want to go back again, just 1 second here.
Through this cloud over the market, the S&P 500, I use this stat a lot. The return on equity, the average return on equity of the S&P 500 is 8.
And so for this part that he's about to go over, he's just literally saying time will compound the results. And even if you think that we're just a little bit higher on valuation than what we should be for our multiple, it doesn't really matter over enough time.
Actually, if you're tilted more to tech, it's closer to 20. Even if you believe the multiple is a turn or two too high, when you accrete, you compound book value of that sort of level. And even if the economy moderates a bit and you bring it down a little bit, that is incredibly powerful. At the same time, there's over $1 trillion of equity buyback in the IPO.
Massive buybacks. Can't forget that. These are things I don't even necessarily think about all the time, but this is really important. So he's saying we're compounding at such a rate that every day that goes by, it just wants to push us higher. Then we have over $1 trillion in buybacks coming soon.
Calendar is small, so your demand, your buy versus sell, is clearly skewed, and then just normal salary and wealth creation drifts into the equity market, and you've got 8 to 9 trillion of cash sitting out there. So yes, I think.
So again, also too, just the wealth creation effect, especially from the rich that are already rich, the companies that already have lots of money, they're getting wealthier. They can offer more pay. They can do all kinds of things, or they could just have higher multiple returns and end up dragging the indices higher, which has its own wealth creation effect. And then we have, he said, what did he say, 8 to 9 trillion sitting on the sidelines waiting to come in. Very good points.
I'm pretty confident equities are going higher. This is not to say we see, we don't see a headline or what have you that presses us down a bit first. And I think you got to manage your risk around that. Mm-hmm. But yes, I'm confident the equity market is going higher.
Do you want to continue to lean into mega cap tech, big stocks? Do you believe in the broadening? I know you like energy. You want to lean into sort of that comeback, if you will. So how does that play out? Your actual allocation, right? I mean, you are head of the global allocation team. So tell me where to lean in now.
So first of all, I still think technology is going to take us to a different level. And I think the amount of investment in R&D, the amount of investment in digital is extraordinary. Where do you lean in? I still think, without going through individual names, I still think that the Mag 7, there are parts of it that are incredibly return generative and will continue to throw off those type of returns as the world becomes more digital. I think the companies that have data and can exploit the data, and there are other companies around that are not in the Mag 7, are the ones that are going to win. My biggest overweight today is what we call the quality part of the market. There is, you mentioned energy. The companies that are throwing off stable, consistent free cash flow, generally aligned with digital, are the places where we like to be. Energy is, while we could debate what the price of oil is going to be, when you throw off 10% free cash flow, and including some of the refiners, there is those levels are pretty attractive. So we're tilted to tech, healthcare, parts of healthcare, but there are also some great free cash flow generators. Some of the there's some opportunities in this market. Like pressed down some of the valuations in some really good companies in the last couple of weeks. I think some of the European autos are interesting. It's interesting to say today, watching some of the casinos come under pressure. I think there's a couple of names there that we're looking at that are pretty attractive today. One thing that's wild about the equity market today, the dispersion is incredible, and so it's presenting some pretty neat opportunity across it. Always enjoy our conversations, Rick. Really valuable insight from you. Thanks for spending time.
All right, Rick Ryder. That doesn't even sound like a real name. But he's great. He works at BlackRock. He's pretty brilliant. I don't know that I agree with everything he said. I don't know that I'd get into European auto. But I like the way he's looking at this market and the fact that there's a number of key things that want to drive us higher. And he made really good points. And I think that the strength that we're likely to see from the big guys because of their reinvestment in their stocks if they drop, again, PayPal's doing tons of that too, right? Or at least they will be. I think that can continue to push things higher as well. And it's not an area I just haven't been thinking about as much, along with the trillions on the sideline, along with just the wealth effect of people that are getting richer and companies that are getting richer because they have a lot of cash. It's just very interesting. Now, I want to go over here. I want to look. Sorry that took so long. I want to look at a few things here. So we're going to start at the top. If I can get my mouse up there. All right, I already talked about the MOVE index. We'll skip that one. We'll go into the economic data real quick here. So I said we still have a bunch of Fed speak today. Some of that, not so great. There was even a Fed that was talking about raising rates potentially this year, that could be on the table. So they just keep going back and forth all the time. So we'll just ignore everything they say. Existing home sales, we already looked at that. CB leading index, I don't know if I looked at that. 5-year tips, those probably are less important. I want to go back to just initial jobless claims and some of the other data. So again, jobs data, it's a nothing burger. It's just sideways. Whether we're looking at initial jobless claims, which again is kind of a leading indicator versus like the other stuff, right? or just jobless claims. Let me see here. Let me go down. Continuing jobless claims, which we started to see rise in late 2022 to early 2023. That was kind of getting a little scarier because it meant, hey, maybe we'll roll over. That's kind of flatlined ever since that time frame. So again, the difference is initial would maybe give us the initial headline of, hey, people are starting to file for unemployment a lot more. So that can give us like the very initial lead that there's a problem in the employment market. But continuing also could let us know like, hey, people are having a problem where they're not getting hired. And so they're staying on unemployment. That could be bad too. So technically, either one of those might lead at some point. But again, not looking bad. And then jobless claims, 4-week average, boring as well. Nothing to see there. So the jobs market, at least from this viewpoint, looks better. But again, a lot of new part-times, less full-time employment. All right, prices paid. So I wanted to go over this, a bunch of Philly Fed data that was kind of interesting. Said prices paid has ticked up and at a glance might seem like a negative, but we're still also below the average for the last 55 years, which is 28.94. So maybe it's a sign of strength and less about inflation. So normally, again, prices paid, you're just going to look at this, you're going to have a knee-jerk reaction and you're going to say that this is really bad. But the fact that we're still underneath the average of 28.94 and just near 23 right now, and that was the average for 55 years, is interesting and notable. So I wanted to give you that perspective. Next, new orders under the Philly Fed. Saw strength. Again, we had this big drop-off that occurred, and now we're ticking quite a bit higher. And it looks strong. And the previous was 5.4, and now it's 12.2. So we're definitely in expansion territory for new orders from the Philly side of the country, which is good because we've got different jurisdictions, right? In case you don't know that. So this is just one jurisdiction reporting. Now, the Philly Fed Manufacturing Index as a broader measure too, also, again, looking like it's in expansion, hitting 15.5. Consensus and forecasts were 1.5 and 1. That's why these numbers are dropping for people thinking of that the Fed might lower rates, is because we're seeing some strong data here. And then we're not seeing a really strong or weak jobs market, right? At least from, initial jobless claims and stuff like that where people are unemployed. Also, Capex. This is an important measure that we need to talk about. It's not like OPEX where you have expenses. This is like what people are spending to build. So let me just read it real quick. Capex for the Philly Fed, but it says, so Capex for the Philly Fed, but employment is down. I didn't finish my thought there. And continuing its downward trend that started at 1.5 years ago. So essentially, and I must have Capex on the other slide. This is just the Philly Fed employment data. So this is showing that the employment metric actually has went down and it's in contraction. So I was trying to make the argument here, and I don't know how well I've voiced it. This other slide probably would have been better to start with. Was that employment is going down, new orders are going up, the index is looking strong. We're seeing Capex, which is basically them spending money on the future to like grow, to become more efficient, all that kind of stuff, right? Where you have some nice tailwinds behind you or pushing you, is a positive, and that employment might be coming down because maybe they're automating some of their different components of their business to increase margins and then at the same time not be as dependent upon employees. So they might be reducing employment size, which again, we know we've lost some jobs. So maybe some of these jobs are being lost from automation where these companies are getting more efficient and their margins are going to get better. And if we look down here, again, it shows the Capex, how for a while there, these companies weren't spending any money on it. And here you go. Capital expenditure, or Capex, refers to the funds of a company used to acquire, upgrade, maintain long-term assets such as property, industrial buildings, or equipment. This includes purchasing new equipment, building new facilities, improving existing ones to enhance the efficiency and productivity of the business over a longer period of time. So what it's saying is Capex is a good thing. When you see investment in this, you're probably going to see greater efficiencies, greater margins, or maybe a reduction in employment and long-term expense through automation is my argument. So it's good that they're investing in Capex. It's not great for some people that are in these sectors that are losing jobs, but all in all, new orders are coming in. They're reducing some of their long-term costs, and while building out efficiencies at the same time. I think this is a positive for the Philly Fed. I think this is a positive, and their manufacturing data looks the same. think I got through all the slides. Let me check. Yeah, I did. Okay, so that's what I wanted to cover there in regard to that economic data. And then again, tonight, one of the things I'm going to be watching is foreign direct investment with China. That's going to be a biggie that should be coming out. I don't know why it's not still on my slide, but that's something I'm going to be checking into. All right, real quickly, let's see if there's any other. Sorry, this one's taking so long. I just got a little ranty there on the inflation topic. I'll try not to do that tomorrow. I'll take a break from it. All right, so let's just look here. We already talked about that. We talked about bonds. We talked about that. Let's see here, seasonality. We can talk about that in a second. Largest pain trade is the opposite of whichever. Oh, yeah, and again, I was just talking to, let me see here. Yes, right here. So the put-call ratio, again, I kind of marked this. I posted about this yesterday. I don't think I talked about it because I think I did it later at night. So I wanted to talk about this. This is the CBOE, Chicago Board of Exchange. This is the put-to-call ratio. And I actually have a post that's even more recent than this, I think, that showed how we're even higher than we were that day. And it shows the monthly time frame. But essentially, if you go back here 20-ish years, almost 20 years, we have never closed a month. This is the monthly time frame outside of this one other date in late 2022 where we close as high as where we are. There's only one other time where that's happened. So what I'm saying here is the chance of us in the next 12 days seeing the level of put pressure get wiped out, which would push us going higher in the stock market, is actually getting higher by the day. So I think there's a lot of pressure building up that wants to drive this market higher. And if we don't do it today, we're going to be doing it really soon. All right. Now, let me see real quickly. Give me one break here for the people that want to stick around. I'm going to go to the bathroom again. I drank a lot of water and I already drank my coffee. So give me a second here. I'll be right back and then we'll get into the stock portion of this. All right. One second. All right, sorry for wasting a minute for you guys. I had to send my wife to get coffee too. So we're back, we're in it. Let's get to charts here. And just take a glance, see what we got out there. I'm gonna go back to Bitcoin real quick. I just wanna see how it looks. Then we'll start getting into comments. So still looking pretty tight here. Let's see where we are on the daily time frame. Yeah, still looking pretty good. I would like to close kind of where we are. If we could, even higher, because that would be like a bullishly engulfing previous candles. Would also kind of get up next to this resistance and give us a good kind of launching pattern to try and to get up to the 65 range. And this would turn into pretty much a tweezer bottom, which we like, right? Last time we had a tweezer bottom, we had more upside. The time before that, we had a tweezer top. We had more downside. The time over here that we had that kind of, it was a small tweezer, but a tweezer top, we had more downside. This is kind of an anomaly, but again, it didn't take much longer before we started to drop because of divergences. So it would be great if this maintained its strength. Let's jump over and see what the rest of this crew are looking like. NVAX, please. All right, we'll see if I get that bar. I will try. All right, so today, MicroStrategy up 1.69% and then down 0.1% in after hours. So it bounced, and we did, if we look here, we're still finding support at the right levels, right? So you can see where we still found it above the fib. So it's still, it's looking to hold on here, and after hours even, we're still here. And if we go to the daily, it could be a bottom. It could be. We'll see. I think markets can still go lower. We'll see, though. But again, I think that I think especially the miners are going to lead us higher. Now, you can see we lost a decent amount of our gains, kind of a large wick here on CleanSpark. I'm sure the other miners look like this too. Must have happened closer to close when I was getting ready. So up 8.78% on the day. And I think, again, we're below peak volumes now. That's not super great. We have this large wick up here. So we could grind maybe in this range for a little bit before we go higher. Here, one sec. My coffee's here. Thank you, wife. All right, awesome. Now my game face is on. Now I'm caffeinated. All right, so again, I don't love the fact that we're underneath of this. We at least have this downward resistance that hopefully we can turn into support and test and then bounce off of. But I don't like how this kind of got weaker throughout the day. At least in CleanSpark, we're up 0.55% in after hours. It'll be interesting tonight too to see what's going on with earnings. I know Netflix is reporting. Let's actually pull some of this up. ASML is reporting. I want to see what these look like. Let me see here. There we go. Because especially tech-related earnings are going to be helpful. All right, so I don't know if we've got a full report. Yeah, we must have. So we got a full report, and that dropped Netflix. I don't know what it's looking like. If you guys in chat have any indication of what Netflix is looking like, or you've been on Twitter and you know what's going on there, let me know. Let me see. I think ASML is another one that was reporting today. And they're down too. Not in after hours, though. Let me see. Let me make sure they're one of them. Let me go over here. We're going to look at the earnings calendar on this fancy little site. Netflix forward guidance was revised down. Okay, that'll do it. Let me see here. So, oh no, it's TSMC. It's Taiwan Semiconductor. All right, so let me look at them real quick and see how we're doing. Ally's also another one that's reporting. That'll be interesting. We should check that out too. Let me go over here. Yeah. All right, so let me do Taiwan Semiconductor next. Let's see how they're doing. Down 0.2%. Doesn't look that bad. So a lot of that was just from earlier. So we're not really seeing anything there. I'm just going to look up, what else do we have? Ally. I want to see if they have a report. I'm just trying to get a bead here. They're up almost 7%, bounced off the 200 moving average, really nothing in after hours. So we're not seeing a lot yet here. Nothing too interesting. So let's continue on. And I'd say a lot of the other miners are probably, again, just kind of bounced off support. There probably isn't a lot to see there. Let's pull up Tesla and then look through the rest of the investment accounts. Tesla made another gap today. So it's got a gap and a gap, and it closed a little bit of this previous, daily gap. So it closed about half of it today. So it's gotten a lot smaller, and that part could stay, or again, maybe we go lower. Totally possible if the market gets depressed. Like Mr. Ryder was saying from BlackRock, markets can overshoot, and so we could go lower, even though the thing that we have helping us right now, especially on Tesla, and I said this in my stream earlier, is right here. It's the fact that we're oversold this far on the weekly, and the last time we did that, we shot up 200%, and the time before that, we went up 3,300 or something percent, and then the other time was way over here in like 2015 or something, and we went up to like 150 or 200. So we have that working towards towards a positive right now for the stock price, and kind of creating an artificial bottom. It's actually one of the reasons why I believe it would be really hard for us to go to $69, even though I love that number and I like to throw it out a lot. That number would be way down here, and it's just so much further. I mean, it's like more than a 50% drop from where we're at, and I just don't see how it's possible. Not with everything that Tesla's doing. If you guys didn't watch my Tesla video, my latest rant, you need to. It was talking about the downgrade, and in it, I went over just a ton of reasons why I think Tesla's margins are going to just get better and better and better each quarter. And then there was another post that somebody had given me. I don't know if I have it saved in here. It was about Enphase. Let me see if I can find it. And it was talking about how Tesla's Powerwall 3 is actually probably going to be painful for Enphase and steal some of its thunder. Let me just see if I can find it here. It's pretty high up here. Let me see. Oh, right here. It's right here. Look towards this post if you want to hear it. It's basically, he's talking here about how the inverters that Enphase had like a monopoly on, that control like 90+% of the market, they're not going to be needed as much, and that it might just be more cost effective to get power walls instead, especially at their low price point and as much power as they're holding and the incentives that you get. And so he was saying that the inverters might be kind of a less important factor, and that they could actually, the Powerwall 3 could actually be a drag on Enphase's sales in the future, which I thought was pretty interesting. And if they're a drag on that because they're selling so many of these because they're a better option, that could just be another avenue where Tesla benefits from, on top of a lot of them. Again, the $99 higher take rate on that subscription. A lot of car companies don't even make $1,000 on profit on their cars, and Tesla could get that in just revenue each year on top of selling it and making $7,500 a car. So there's so many levers they can push. It's just, people are stupid if they don't understand this. If they're not paying attention to that and they're just bitching and crying about the price, then they're being idiotic, in my opinion. Let's look. We'll pull a Palantir next. Maybe max Tesla downside is 99 to coincide with the FSD pricing. Tinfoil hat. Yeah, maybe. Who knows, man? Could you please take a look at DLO options? The $30 strike for January 2026 suddenly dropped to 1 cent and is now 30% down for the day. That's a hell of a drop. Let me check it out. Yeah, give me a sec. All right, Palantir. So Palantir, again, it's underneath the fib level. That's not great. There is some volume support though that starts around, the $20 range. So maybe that can act as a bottom. Otherwise, it's down to like the 19s, the 18s before we hit the 50 here. We close that daily gap. That should be really strong levels of support from a multitude of levels, including the RSI, the MACD, all that stuff. So it could be good. Let me see DLO. Let me look at the stock price first, and then I'll look at the option. Stock price is down. It's not like crazy down, 2.69%. Maybe people are just, they don't know enough about DLO. They bought in, they didn't trust it, and they sold. I'm seeing down 9% on the $35 contract. Which one did you say you had? $30 strike. Yeah, I don't know. That could be a number of things. Maybe there isn't as much liquidity in there. If you haven't watched my Options 101 video, you need to make sure that you understand which strike you're picking, and you want to make sure that there's open interest and volume in it. Maybe the 35's got a ton. Maybe the 30 doesn't have a lot. And somebody who is bigger sold a bunch today. And since there wasn't enough buy-side liquidity, it dropped the price really hard, which, again, you want to be able to sell and buy when you want to, which is why you pick the ones that have the high volume and the high open interest. But watch that video. It does a better job explaining a lot of that stuff. I think that could be what you're missing. And it might have been why it got so crushed today versus this one that's down 9.77. It sounds like you got a multiple worse to the downside, even though you have the same amount of time. So check that out, maybe. That might help. All right. What else we got? So we covered DLO, I guess. Oh, and again, it rejected. It's actually still kind of finding volume right on this little line. We'll see if it goes lower. And if it goes lower, it could just test back to where it was before, at like the 14.5 range. And if I have money from something going up for a change, I'll probably be a buyer. All right. Also, did I even cover this? I guess I did cover this. Yeah, 1 day left. Yeah, I covered that. All right, let's go back. Matterport. Nope. Let's go to the others. I'm skipping a bunch of my mains here. SoFi. Yeah, check the options video. I think that'll help you. SoFi down 0.42%, up 1.1. The volatility is just kind of gone. I'd say this is a positive all in all. It's kind of crazy how much that's changed. All right, let me do this the right way. Hood. Let's see what Hood did. I sold all my Hood so I could buy Tesla that was falling. And it looks like Hood, just kind of meandering. Kind of seems like it's finding support. It was flat on the day, only down 0.12%. Kind of feeling like it's finding support. We'll see, though. It's still underneath here. It could reject and maybe just keep falling if the general market does. But it looks pretty good. PayPal. I think PayPal, again, got butchered today. I don't even know why. Does anybody know why? Brian Tinsey, car companies are playing checkers, Tesla's playing chess. I agree. All right, so PayPal. PayPal actually, what was interesting though, is it found support on peak volumes. And somebody said, like, what's the most frustrating stock ever? And they were like, PayPal. I kind of can't argue with that. I mean, it's down almost 80% from its all-time high that was like 3 years ago. It's pretty frustrating. But on a bright note, so today it dropped 1.83%. Again, we kind of had that rejection level, and we found it. We found support. This is the first time that we've really back-tested support and could potentially be finding, support on it and then trying to test higher. So this could be max pain for PayPal. We'll see. It would be nice if it could find support here and then get back above these peak volumes at like the 63.32 range. That would be ideal for further upside for PayPal. All right, let me see. People said I was forgetting Square. I'm going to try not to do that. PayPal got hit pretty good today. Square got hit pretty good today too. Down 2%, down 0.25% after hours. Looks like it wants to just close this gap. Not a lot of volume in here going down to like 70 to the 69 range. Maybe it just wants to close the gap before it goes higher, because it does have daily gaps over here that I don't think they ever filled. Let me go back. Yeah, so it's already got 2. So probabilities are like 90% of gaps fill. So if we've already got 2 other large ones, these are probably the ones that aren't going to fill. So maybe we do close the 69 level and just call it a day. This one was holding up strong for a long time, so it looks like it's just going to give up here and let her go. And I don't think that's necessarily a bad thing. All right, we did DLO. Let's do Matterport. If I'm forgetting any other stocks that I normally do, remind me. It's for his OnlyFans. What? How, Jesse? How and why do you use PayPal so often? It's not for my OnlyFans. I use Venmo because that's the credit card I always use. And then for PayPal, if I'm buying things online, a lot of the time, one of the first options they have is for PayPal. And so I just use it, because if I go through PayPal, I can use my checking account, or I can use my checking account as like overflow, where I use another account, but through PayPal, and then the checking account, if there's nothing left in the other one, it'll just go out of that. So there's ways to and it's so quick. It's just so quick and easy to use. So I use PayPal like the most. All right. Now, Matterport. Oh, and I didn't pull it up the right way, so let me do that to where I have the chart. So Matterport is looking like it wants to find a new low, or at least this is where it needs to bounce. It looks like it was just a hair underneath of that, actually, though. So, well, no, excuse me. I guess it's not. So maybe it'll hold at 175. It would be nice if it did. But again, the data is kind of like higher for longer, which is another reason why Tesla's getting hit, on top of many reasons that people want to hit Tesla. And I'm sure companies like Enphase, I should actually check Enphase real quick, are getting hit. So these interest, rate sensitive companies are going to take the brunt of the pain. Let's see. I would assume Enphase would be down today, down 2.57. Yeah, and it broke down out of this. So Enphase could go to 100 pretty easy, and then maybe even drop to the 80s. So I don't know. I wouldn't feel comfortable being long Enphase, especially with what I've learned about Tesla Powerwall 3. All right, let me see. Flux. I think Flux got its ass handed to it today too. I think anybody who just jumped into things that they're not as confident about and that might be small caps, they just got butchered. And so today, Flux down 4.92%. Did I even pull up my buying? I don't even know if I did. I did buy more Tesla today. I don't even know how many contracts I got, maybe 30. I also sold Best Buy puts. I'm actually out of Starbucks puts and Best Buy puts. So hopefully we stop dropping, because the money that I'm making from those is gone. So I would love for us to stop there. But as we get, if some other investments, like if crypto does start taking off or something else starts to do really well, I'm probably going to split it between things that are getting hit a lot. And maybe this comes into it. I still probably have like just, in the upper 40s for this right now. And so that's probably still a high enough position for me. All right, I can't think of any other indicators I want to pull up right now, so I'm going to go to your guys' questions. Let's go to the top here. Renewable energy investments. Can you do LESL, largest pool spa retailer, seasonal, enjoying the content, homie? Now, if it's seasonal and it just seems like that would be something that could be interest rate sensitive, like pool and spa retailing, one of the first things I think you're not going to do is buy a pool or a spa or spend a lot of time servicing it or getting work done. Personally, that seems right. Let me see. Oh, I didn't mean to do that. I want to do a copy. Copy chart. There we go. LESL, I think you said. What was it again? Or maybe I got it wrong. LESL. Okay. That's this one. Cool. Woof. Yeah. I guess it's bouncing. Wow. Let's look at finances on this one, because this one back in 2021 was $33 and now it's $4.41. So 85-ish% drop, pretty hard. Oh, I don't want this. Let me close this. I want this. Let me bring it over. All right. We're just going to look at financials here. Might have to expand this, make this more viewable. There we go. That looks a little better, I think. Yeah, maybe too much. Right there. All right. So looking here, revenue growth is dropping, but there is some seasonality, but I don't like the fact that the season is kind of rolling over. They do make money every once in a while, not a lot. It's an $813 million company, but let's see, yearly, what did they pull in? In 2022, they were pulling in $160 million, so that looked good. You can see how rates increasing, though, probably just neutered them really bad. It probably chopped the top off of this number. They probably would have been higher for net income. And then in 2023, it's just decimated them. They have a decent amount of debt at almost $1 billion and then only $55,000 in cash. They had positive cash flow, but that's been turning negative for the year here. So, yeah, you could just kind of see some pain that this business has experienced. And let's look at estimates. And we're not seeing like a real increase in revenue that's substantial at all. Maybe flat to just a little bit up. And then institutional ownership has been flat. And then the only thing that's happened since 2020 is just a bunch of selling. Not super great. Short interest isn't that high. Well, I mean, it's almost double. No, it is double digit. Never mind. I guess it's just been that way for a while. Now, stock-based comp is like 1.55, so that's not really a thing. Strong seasonality component, like you said. But again, people kind of already know that. I don't love the debt levels. I don't love the lack of growth. And I don't love how they're sitting right now until rates get better. So I'm going to say 813 million might be fair, considering their, let's see here, for 2023, they lost 31 million, made 72. So we'll just call that made 40, made 56, and then lost. So they made $16 million in the year, in the entire year on an 813 cap, 46 PE. Forward PE looks better. That looks better, but I don't know. It just doesn't look exciting. It's not an asymmetric bet, that's for sure. And then it looks like it could still suffer for a while if the higher for longer is a thing. But if it's not a thing, then maybe they can start, to see some bounce. But I'm not excited about it yet. Thinking of it as a potential to be real estate interest rate turnaround. Yeah, maybe, but it's just not a high multiple one, in my opinion. Not that it couldn't do better. It might do better. But again, I don't know. I just don't see. If we can get back to even 160 million net income in a year, then you're right. It could double. It could double. Maybe a little bit higher. But that's just like there's so many other better investments right now, in my opinion. Lisa Marie, good day, Jesse. Is there time within the next few months that you would consider TLT leaps? I wouldn't do leaps on bonds, especially TLT. So one of the things that Ryder, that BlackRock guy, was just saying a second ago, was that you should kind of stay away from longer duration stuff. I would agree with that. And I think I have TLT on here. And there's another problem. You don't want to do options on TLT because they play out over extremely long periods of time. Right? Like our last high in the bond market when it was doing really good was March of 2020, over 4 years ago. You're not going to find a lot of options contracts that give you that amount of time. Now, maybe the bond market starts to recover, but if the 20-year starts to recover, maybe not. Now, the shorter term, like the 2-year, these shorter interval ones, they'll return a lot quicker, right? But do you really trust the government's ability to repay debt 20 years from now, the way it's being fucking run right now, when our interest payments are higher than they've ever been in the history of the country as far as our debts? We're servicing our interest is becoming a higher expenditure than our military. I mean, it's not good. It's not good. And so if you don't trust it 20 years out, then that's problematic, right? Because if you don't trust it 20 years out, then you're not going to buy these. You're going to buy the shorter dated treasuries before you touch this shit. So I don't know. It's just, I don't think longer duration stuff is good. And I definitely would stay away from options in regard to it. Definitely. All right, Joni. Hello, Jesse. Do you think MSTR will eventually soon do a stock split? Maybe. They don't really have to. Stock splits don't really matter because companies like Robinhood will let you buy fractional. And so if people can't really afford it, they're probably trading on Robinhood anyway, and they can still do fractional shares. They just put like, I want $1,000 of MSTR. And so there's a lot of exchanges that can do that kind of thing nowadays for people that are poorer clientele. So stock split really doesn't do anything anymore. The Kaiser Clinic, can you go over DLTR today, please? Hey, Jesse, awesome to follow you. Thanks for sharing. Please take a look at that FET stock. Except for the same. Oh, that's a different person. All right, DLTR. Yes, we can look. I don't think I have that one. So let me pull it up. Dollar Tree. Okay. Should be like the $5 tree, right? Chris, thank you for joining, man. Appreciate it. That will give you the ability to comment, and you can ask for stock picks when I fire up a stream. And I fire up the stream actually like earlier in the day, and so you can come in and put a comment, and then I can take a look at it. Now, Dollar Tree, let's see. I'm curious how the revenues are doing. I got to look at them first. I know some of these dollar stores, they've got a weird experience in big cities, but how are they doing otherwise? Revenue pretty good. Nice quarter. Fascinating. All right, let's look at estimates. So, still kind of ticking up, but there's a seasonality component. EPS looks good. They had one bad quarter. I don't really know why. And, they lowered their debt substantially, and then they've been doing share buybacks. Operating expenses, I don't know what happened last quarter. There's just a bunch of stuff in the chart that's out of whack. But institutional ownership ticked up last quarter. Short interest plummeted. And insider buys have been very strong since Q1 of 2022. So they just definitely see value here. Now, stock-based comp is a very small amount. Doesn't even matter. Well, I didn't know everyone commented team was a member. Only took me a month to learn. Yeah, everybody on here. I don't allow non-members because then people just talk shit and fill up the chat. And a lot of people that don't have a financial interest will waste a bunch of time. And so I figure with a $3 fee at the very least, you can pay more if you want, if you believe the content is valuable. But with a $3 fee, you get rid of the riffraff because they just don't, they don't want to pay to talk shit. So you don't have any of the bullshit. You have people that actually want to grow the community and have it be positive. And that's what I did with the verified thing on X. People can't comment on X unless they're verified. And I did that also to get rid of bots because bots are fucking ferocious and they're tons of maintenance, and I don't even have to worry about them if the only people that can comment are verified with X, even at the smallest level. It just makes my life so much easier. So yeah, that's why I do it here. That's why I do it there. I don't make anything on the X side though, but at least I make $3 a month. Well, after YouTube takes their 35 or whatever percent. But yeah, at least it's a better experience too for everybody, and then I get a little bit of income, so it's a win-win. All right, so Dollar Tree, PE is negative right now. Forward PE is 17, not crazy. I don't know. It's a decent stock. I just don't know that it's exciting to me. It's obviously fallen down. There is, from a technical standpoint, a little bit of a gap down that it could do to 117 or something like that. It would probably find support at that level, and then it could go higher. And I'll draw a fib here real quick, and then I'll call this one good. So we'll probably draw the fib at March of 2020, the low end, because that's usually a good one. Then we try to go to the first like major high that we had. Actually, no, we're going to go up here. We'll do this. We'll do this instead. I will draw it from here. And I could, because there's another major dip that occurred in October of 2021. I'm actually probably going to use that one. Yeah, I'm going to, because it'll kind of give me a better representation of local highs. So, again, we kind of fell underneath. This looks pretty lined up correctly. We fell underneath this fib. And so, again, to gap down to like 117 or something is not unheard of at all. I'm just going to lock this and save it, and then we'll move on. All right. What else we got? Hey, Jesse. This is from Karsten. Hey, Jesse. Awesome to follow you. Thanks for sharing. Please look at FET stock, FET. I don't know how much about it. It's an energy, and the chart drop are nuts. Thank you. All right, let's take a look. I don't know if I have that one. I've got a FET, but I think that's just like crypto. Oh, did that work? Yeah, it did. All right. All right, Forum Energy Technologies. I should probably look at this one. Huh, earnings are weird. Yeah, we should actually... Wow, this is a crazy fucking stock. This looks like pain. It looks like a very clear rollover trend, and you're under peak volumes here. This looks like it could go further to the 16s or maybe like 12, where you start to really hit volume here. Not a great looking chart, man, at all. I'm just going to look at the financials here, because that's just ugly. Let's look at the yearly. That's why. Since 2013, the company's just been dropping, almost like a seasonality towards the downside, where they go up most of the year and then they fall. And so net income is flat. Forward PE, it says 149. That is right. That is pain. Wow, massive revenue forecast for Q2. This is a weird company, dude. I don't know what to make out of this at all. Stock-based comp is not a big number now. This is just all over the place. Institutional ownership ticked up in Q1 of 2023. Short interest is super low. Maybe this company is going to start doing a lot better. I'd be curious, do Q3 and Q4 revenues look like this? Is it long lasting? Again, there's just some weirdness with this stock where revenue was going up till 2014, then it fell hard. But now it looks like they're forecasting for some really great revenues, even though the stock is depressed. So it might be interesting, actually. All right, what's the effect? All right, so this might be interesting. If you know more about the company and like the actual fundamentals behind it, it would be interesting to know that. Disease Kodak. Hey, Jesse, if you want to, can you do a video speaking of the importance of ARKG? You mentioned you were thinking of doing... I actually do have one talking about my options trade with ARKG and why I liked it. I don't know if there's an importance to it. I just think that it's the fact that they have a bunch of... and they're invested in a bunch of different, biotech-ish plays and genomic plays that if one of them takes off, then I think the stock could double easily. And the last time I looked at my contracts for them, it would give me a 10x. But you can see that in that old video I made about ARKG. Take a look at it and then just run the latest numbers in the options calculator, and you should see it. But it's a good return in my opinion. I like it. I think it's still a good play as long as the market becomes more risk on. Again, right now it is not. It's not, right? It started to be. Small cap started to get their bid, and Bitcoin was flying and everything was looking great, and then we've just stopped doing that for the last several months. So we need to get back into that phase again. Fear and greed was really high. We need to fall back down, and I think we're going to be doing that. Fear and greed was 34 today. I don't even know if I looked at that. Let me pull it up real quick here. So fear and greed was at 34. It's not that far away from touching extreme greed. So again, like from where we were sitting forever over in this extreme greed territory, going back in December to just this massive drop that we've done, a really steep drop, actually, even steeper if you look over here than what we went for going up in November, October to November. So we're getting to a point where eventually it's going to be pretty oversold, and the likelihood, and I think we're kind of already there, but the likelihood is that we'll end up going up. All right, let me jump back over here. Hey, Jesse, if you want to, no, okay. Disease Kodak, hit the likes. Yes, please hit the likes if you could, guys. If you're here, please do that. I should have said that earlier. Gartop33, hey, Jesse, can you comment on possible drawback if Israel responds to Iran and Lebanon's Hezbollah over this weekend? They've actually already been responding. They killed like a higher up general in Iran, and they've been doing attacks into Lebanon. It's just nobody gives a shit. Could there be more? Yes, there could be. And Russia's starting to be more vocal about helping Iran. They're very much on the Iranian side. In fact, I think they probably worked with them to kind of do the whole Hamas thing. I think Russia probably knew about that, or at least, the baddie portions of Russia, not the people of Russia. Intelligent computing. This might be too small to warrant a look, but health tech microcap INVO Biosense recently reported being profitable for the first time, contrary to estimate. I can take a look. I wonder if that one's a part of ArcG. The problem I have with these, I'm going to look over here first before I look at the chart. The problem I have with some of these is, okay, they've reported being profitable. Did they report being profitable? What was their earnings report? Is it today? Earnings April 1st. Okay. I mean, were they really profitable? Did they guide towards profitability? They've guided towards, they've got more revenue, right? Like the revenue's increased. I don't have a guide here. But just at a glance here, this doesn't look like it's profitable. They lost $1.5 million and they made 1.382. So I don't know if there's talk about them being profitable, but I don't know. I mean, it's good that revenue's going up. Hopefully they can start finding a path to profitability. It looks like there's a little bit of a trend going that way. But they don't have a lot of cash, bonds, all that stuff's gone. And they have almost $7 million in debt. They're valued at $4 million for a market cap, so they're super tiny. Doesn't give them a lot of leverage. And insider activity, let's see. They bought back in 2018 and 19, but nobody's really bought since. Institutional ownership is not great. Short interest is non-existent because nobody even knows this is here. So this would be one, if I knew that things were going to get a lot better, great. But stock-based comp is 67% of revenue. I don't know. This is another weird one, and it's super small, dude. It's a super small company. If I actually knew this company, great. But AWM Investment Company owns all of it. It looks like, well, no, this is weird. There's something weird here. This must be broken. Or, yeah, I don't know. I don't know. Alejandro, if you're here, look at this one. This is weird. All right. So, but anyway, either way, I don't know. I don't see profitability here, so I don't care that much. All right. Intelligent computing. I won't be here for the start of the stream again. Smash the like. Thank you, sir. LB, are our stable coins something we can invest in? What's your thesis? It's not, actually. It's just like the dollar. So, no, you really can't. You could own it as a dollar. Sometimes they depeg from the dollar if they don't have as good of liquidity. So you want to own a bigger one, like a USDC or maybe I don't even know if PayPal has enough liquidity yet. But you can own them like a dollar. But you can't invest in them. They don't do anything. Intelligent computing. Copper is zooming, going up. It's seen as an economic indicator. 43% of copper is used in building construction. 40% is used in transportation, electrical. It's probably just chips, dude. I don't know that it doesn't, it's kind of tough to say that that's an economic indicator. It is something. It's a part of it. And so let's look at commodities real quick here. Let me see, copper. Copper is up. It's up. It is up. And it's up a lot over the short term. But I think a lot of this is just chips. It's not building and stuff. It's chips. And so that we're right. I mean, that part is doing really well. The computer, electrical, semiconductor, any copper use in regard to that is probably, I would say, going up a lot. What does it say up here? Copper futures surged to $4.40 per pound in April, the highest in nearly 2 years, as concerns of low supply were met with signs of traction in demand. Satellite data showed that the copper smelters in China, the world's top producer of refined copper, I love that we're using satellites to look at them, decreased activity levels to act in line with pledges that their output could fall up to 10% this year. So they're actually reducing copper, and that's why the price is going up. It's saying the move marks a response to the low supply of copper or for Chinese smelters. So there's lack of demand, magnifying the sector's overcapacity to drive smelting fees for their lowest in years. Among a wave of lower ore supplies, Zambia suspended activity in key mines due to power shortages, while Panama's Cobra mine was shut down and South American mines. So you have a weird combination of them doing less, like China's doing less, and then you have less supply going out too. So it seems to be a couple of weird factors that are causing that. Copper use in chips and mine is amounts. I can't quite see it. Use in chips is minute amounts compared to pipes and cable. Yeah, again, we know new home construction, at least in the United States, is really going really well. It sounds though that lack of supply is also driving some of this. And then again, China, the world's top producer of refined copper, decreased activity. So they're lowering the amount they're refining and creating. And then you also have, less copper being put out from a number of mines. And then maybe you, again, I don't know if it's a minute amount in chips. Yeah, we know new housing is doing really well, and we know copper is used in that. So maybe that's it. All right, let me go back here. All right, I won't be here. Okay, we did that. Copper. Okay, Disease Kodiak. Hey, Jesse, for subscribers, the perks say we can message you on social media like X. I can DM you because you follow me, but I can't respond to your posts. Is there anything? Yeah, I don't think so, man, because, again, I don't want all the bots. Like I was talking about earlier, bot maintenance is such an issue, and I don't want to have to hide shit. I don't want to have to block bots constantly on my page commenting. It's just much easier to have it clean, just like it's clean here. Ideally, I would be able to do that with a subscription, but for X, for some reason, for like 10 months, I've had a request out there to have subscriptions, and they won't do it. And I would probably set it really fucking low just to get rid of bot spam, like $1 or something, but I can't get that from X, and it's not just me, it's a bunch of people. So once they do that, though, I'll probably do like $1 subscription on X, and then that way I don't have to worry about bots, but people can still comment, and we can get more comments. I do like the idea of that. Intelligent Computing, did you ever have a look at Tom Nash's stock MVP platform? I just glanced at it. I like Tom, but I glanced at it, and I don't know, at a glance, I didn't find a lot of value, and we were going to have a follow-up. Never really had that. So, and I don't really do the scorecard thing. I don't do the scorecard thing. I look at markets from, like, I believe a lot of detail, not just like a number printed out, so I should buy something. So again, I might be underselling it. I haven't really looked at it, so no. Wild Frenchie, bonjour, hope everybody is doing great. Can you take a look at FLNC, Fluence Energy? I think that's different than what we just looked at, so let me go over here. You guys in your energy plays. I actually think energy's like the Rick Ryder, I can't believe that's a real name, was talking about from BlackRock. I actually think energy is going to be like a solid play because we're just going to need so much. I think if you're good with, I'm not good with like understanding who the big players are in energy and who's going to make the most amount of money as we transition potentially away from less oil towards more like electrical energy needs. I just don't know. I don't necessarily know who all the good plays are. If we have a really good energy person in here, we'll have to figure that out. Or maybe we can have conversations with somebody. If there's a YouTuber that's really good with energy stocks and knows kind of where the future is heading with energy stocks, and what the most valuable ones will be, what the ones that will be that will go up the most. I would love to know it. So Fluence is underneath peak volumes. This is a $2.78 billion cab. It's went up. Kind of looks like it's rolling over, but maybe it's going to try and find support before going higher. But really, let's just take a look at this to know what their financials look like. So revenues actually look like they started to diminish. It's 17% year over year, but it looks like they had kind of a tough quarter. Estimates, though, have us going a decent amount higher. And then again, Q2 actually ticking to new highs. So that's cool. And then EPS actually being positive. That would be good. Let me see here. Not a lot of insider buying. Institutional ownership is going up. Short interest has went up. It's actually high, 13.72%. Why is that? I don't know. I mean, if they think they're going to get maybe even net income positive here soon, they were the quarter before last. Cash flow maybe is ticking up. This could be a more decent company, but a $2.8 billion valuation. Their forward PE is 53. That's probably high for an energy company. Jesse, I was going to ask you to do a video on electrification expansion stocks. Perhaps we can collectively brainstorm. Yeah, I'd need to. I don't know. Again, I don't really know that sector well enough to know who's the greatest benefactors are going to be. I'd like to, because I do think that that's a play where energy is just, it's a steady eddy, right? Like it's one that's just going to keep printing in the years ahead if you pick the right companies, because the energy demands won't go away with massive electrification. We know it's in the electrification section, right? All right, let's see here. Disease Kodak, yo. Round two, let's get it. Yo, what's up? All right, you guys must have been listening to music or something. Oh, I went too far. Oh, I hate it when I scroll down too far. It's such a pain in the ass. Whoa, there's a lot in here. All right, there we go. With you on the January 2025s. Yeah, they're painful, especially PayPal. Hey, thanks for the macro. Do you still think PayPal bounces to 67 to 72 soon? I do. I think maybe it's earnings that's the key driver. Maybe we play down and just grind for a little bit. I showed the stock earlier. We got a nice support zone for us to just grind up against, or maybe even bounce off of now. I do think that we're reaching peak pain in PayPal. Maybe not for the January 2025s, because we actually have to start seeing momentum to the upside for those to do better, because the strike is just so far away. 140 is so far away from where we are right now, at least between now and January 2025. You'd have to get a good move and momentum in the stock. I do think one is coming, and we'll have to see. I might exit at the 80s or 90s the way we're going here, or at least start exiting sooner than I would have. All right, Alex Hoisenlar. I second Drew's question on Elon's comp package. Probably negative for the stock if it gets rejected. Yeah, I don't know, man. It depends on perception. I don't think it's going to get rejected because there's a number of institutional investors that want to do it. And just people that know that keeping Elon driven is probably the primary thing you want to do. I know one of the big wigs that I was posting about the other day that bought 600,000 shares seemed to be supporting not passing the comp package. Even if it doesn't pass, though, I've got a feeling that they'll restructure it in a way that will get it to pass. And so even if it doesn't go through now, I'm not really too worried about it. I think it'll just end up taking another form. Sarthak, thank you for being a starter pack, man. Appreciate it. Disease Kodak, everyone like, yes, please. Welcome, Sarthak. Thanks. And Sarthak said, what do you think of Marvel, MRVL? Let me just look here at the financials on it. I don't remember off the top of my head. Or Marvel, I think Marvel. Now, looking out here, let's see here. Estimates are going down. EPS is going up. Insider activity, selling more than buying. Institutional ownership's going up. Short interest going down. I don't know. It's a $56 billion company, and the forward PE is 34, and they're not really good at making money in the semiconductor space, and they've got more debt than that. I would say it's not great. It's not a great valuation, in my opinion, especially with revenues going down. That's probably all I have to say about that one. Not even really interested in pulling up the stock unless you want to see it more for some reason, because you own it. Like maybe you want to see a support zone or something. LB liked Steven or Kevin Stover. Hit the bottom and show some love, or hit the like button and show some love. Kaylin Bedford. Hey Jesse, have you heard of or looked into DXYZ? For people that might have missed that, stay away from that stock. It's running at an 800% premium, which is fucking bad. It means that it could drop like 90%. So if you made money off of it, GTFO. Brian Tini, Netflix down after earnings. How are they doing now? Let's see here real quick. How are like all these guys doing? Let's see if that's gotten better or worse after their conference call. They should have had the conference call by now. Let's see here. I'll let that start to grind. Doesn't look super great. Down 4.27. So again, kind of establishing lows. Let's look at Taiwan Semiconductor. I don't know though. Theirs is weird. I don't know when their earnings are because of their time zone difference. Maybe that hasn't even happened yet. Let me look at Ally Invest. Ally Invest. I'm curious about this one from a brokerage standpoint for like Hood, Coinbase, that kind of stuff. Oh, it looks like I just got to change it up here because I must not have the ticker. So I'm just curious to see. I think they're reporting today too. Let me just see if that's true. Hey, beats. I wonder what guidance looks like. Cool. Cool. Don't hate it. And maybe they were a morning one, and that's why they were up so much. So, cool. Hopefully they do all right. All right, let me get back over here. Question, BCHG007 question. Can you explain conceptually BTC dominance when will the shit coins start to have a major run in 2024? Sure. I do have a chart for that. All right, Bitcoin dominance. So here's what normally happens. So you normally have Bitcoin to where it hits kind of this resistance level. It starts to do well, and it grinds up. Like, let's look here. January 2021. So Bitcoin dominance was at its peak, and then afterwards, it just fucking plummeted. That was the altcoin season, right? And then, and we didn't really fizzle out in 2021 for like another 8-9 months, right? So we're not there yet. We could still see Bitcoin go up. I think we could see it go up to here. I think we could even see it break past this and maybe get up to 60% dominance if Bitcoin becomes like a safe haven or if it does really well. But again, in the previous cycle, March of 2017, we peaked in like December, I want to say, or maybe, December of 2017. But in March, again, about 6-7 months beforehand, we had a massive drop in Bitcoin's dominance. This is the altcoin cycle. This is when people don't care about Bitcoin anymore. It's passe. They think they've made all the money they can make off of it. Bitcoin's still going up, but it's not going up as at the multiple that the altcoins are. And again, that same thing happened in like late December, and it went all the way down to like May of 2021, and then we fizzled for a while, and then the markets really started to dive in like December of 2021 and something like that. That's where Bitcoin started to get hit. And if we look over here, we can line up some of those dates. Let me just pull it up. Woof, we've done a long one again today. I had that big rant about inflation. So again, if we go way back here, if we take the way back machine on Bitcoin's price action and go back to our previous peak here, markets started to get toppy April 2021, but that really wasn't when it got toppy. It was when we found out about rates in like November. And again, I think that we would have actually maybe went into December at that time and gotten even higher for a top. It's just, I think we got neutered by the Fed. But again, just like almost a year of really upside that you could have made in altcoins. And so we might be out, months before we see like an altcoin type rally where they start to go. Market will definitely have to be a lot more confident. Maybe it doesn't even happen until the latter part of this year in like August, September or something like that. I think it will start to rally over the summer. It has a tendency of doing that too. All right, let me see here. All right, Brian Tini, every economoron knows they need to increase corporate taxes to stop inflation. Congress would never do that, though. I don't really think that that's going to stop inflation. I don't think that really matters. Again, I don't even know that we have to worry about inflation. I keep going back to the fact that Europe is a fucking mess and deflationary or borderline and not looking like it's expanding in any major way or requiring a lot of anything in any major way. China is very much in a deflationary state. Japan is getting pressure on the yen. China is getting pressure on the yuan. There's all kinds of things that are going to constrict demand. It's just we're faring a little bit better in this country. Why the fuck is that so bad? Does that mean we're going to have runaway inflation in the future? I don't see it. I just see a healthy looking economy, at least, and I don't want to say healthy looking economy because we're incredibly indebted, but I'm saying it where we are right now, we don't mind having a little bit of inflation. 3% isn't a bad number. It's a totally okay number. That's just not the narrative right now. But it will be in the future. That's my thought process. And we don't need to tax corporations. Yeah, some people think that taxes are like, every economoron knows they need to increase corporate taxes to stop inflation. So if you increase corporate taxes, you actually probably end up hurting those corporations. And you can do things where you have it to where they don't do buybacks and all that stuff and don't prop up the markets. But again, if we start crushing markets, if we start crushing corporations and making it to where their earnings get revised lower, sure, we can get rid of inflation. But if inflation is already naturally just going away and we have just these lingering parts like high insurance, high taxes, all this stuff that's just suppressing customers or people's ability to be able to spend, and then you have really high rates making strangling them, you're just going to destroy the economy. So we want to release the valve, lower rates. That's how we help. It's not putting pressure on corporations. That's like one of the only good things going on right now. And then putting pressure on corporations. What we don't want is a death spiral. China is already in one. If you go into a death spiral when you're heavily indebted, you're fucked. So the thing we need to be worrying about is going into something like that. It's not inflation. I'm just going to keep saying this over and over again. And we don't need to hurt corporations right now. They employ people. It's not a zero-sum game. Companies making a bunch of money can do all kinds of things to increase margins. Then they can expand. They can hire more people. We want low unemployment. We want them to hire more people. We don't need to punish the success of businesses by taxing them a bunch more. That's what socialist, communist states do. And I can tell you their economies are dependent upon us. So we don't want to really focus on that a lot. Not that they can't be taxed at a higher rate. This would be a horrible time to do it. That's my argument. And in the future, corporations, especially with automation and robotics and all this other stuff, they will have to be taxed more because you'll have less people working and you'll need to be able to have more social programs to help those people if you don't want to have just homeless people robbing and shooting people all over your cities. So I'm not exactly somebody who doesn't think that taxes will go up in the future either, just to be clear. LB, don't they have to keep rates high to prevent housing? All right, we already had that one. Joey Spinello, hey, love the recaps. Really helpful insight, thank you. If you have any time, could you look at Rocket Companies? Is that Rocket Mortgage? I think I have my mortgage through them. RKT, is that the one? I don't know. Let me see, RKT. Nope, not there. All right, make a copy of it. I'm probably going to call it in about 10 minutes because I just went, I don't know, I'm just not efficient with my time today or something. I don't feel like I'm getting through things as quickly. Tomorrow I have to caffeine up, make sure I get my potty break in, and see if I can go longer. Now, again, the mortgage industry is suffering, right? Like, so these guys aren't, they're not, it's not like they're getting any new mortgages spun up. They're getting ones for new housing, but it's a trickle, not a strong flow. You can probably see that really good in their financials, though. I think this is actually probably a really good thing to look at. So let's pull up visual stocks just to see their impact. I mean, look at that. Look at 2020, guys. Billions of dollars in revenue. And then like, bleep, not even. I'm sorry, in a quarter. In a quarter. And let's look at the yearly. So again, you could see how 2020 was just abnormally crazy. 2021 was still strong. Then we started tightening rates and Rocket Mortgage just got crushed. They went from, $9.5 billion net income for 2020 to $6 billion. to 700 million. So this is a good example. This is a good view into the mortgage sector and just how fucked they're getting. And then, I mean, they've been buying back stock for a long time. That's cool. It's barely registered here though. So it's not too big of a number. And then they sold pretty heavy in 2020. You can see why, right? They made their fortune, then they just sold a shit ton of stock. That's what a lot of these executives did. They got really rich in 2020 during the pandemic. And then if they were smart, they took that money and then they waited for the right time to invest and got even richer. Institutional ownership going up. Let's see, what are we valued at? 36 forward PE. It's not like it's super cheap. And yet, they could grow a lot when rates flip around. But I don't know. It doesn't look that enticing. It's just another one of these where again, it could close up to this level, like the $20 level, but I just think there's other opportunities that are better out there. If it was down here and we were getting ready to flip on rates, it was down in the 7s and we had this run potential to the 20, I would look at it as a nice asymmetric bet. But for right now, I don't know. Again, it could get to 20. All right. Let me see here. Let me get down. Nobody's selling because nobody's selling mortgages because they locked in 3% interest rates. Yes, we do. We need rates to go down so we can open up inventory. Marty McFly, more likes. Thank you. Lisa Marie, gas is $5.45 here. How does any regular worker afford it? That sucks. I'm assuming West Coast, but maybe you're just in a big city. Shiva Rope Gowd. I just butchered your name. Sorry. Hey, Jesse, what do you think about Intel? It's beat down a lot. I think it's beat down a lot, but they've got a lot to show. I probably won't pull it up right now, but they just haven't made a lot of money, and they need to prove that they're going to be in demand in the future and that they're going to be able to compete against NVIDIA and do it soon. I know they're trying to do something to compete against them, but they're also trying to build out their foundry business. I don't know. I think eventually they're going to kick off. I probably should start following some of their earnings calls. Maybe I'll queue something up for Intel and add them. I think it probably will actually, because I think I need to add earnings call. I think I need to do that for a few of the chip makers. I need to start doing earnings calls with them so I can better understand demand, because I do think it's the oil of the future. All right, let me see here. What are we getting out of time? 5 more minutes. Maybe I'll draw before that. All right, yeah, let me get down. Hey, Jesse, what do you think? All right, that was that one. Disease Kodak, crazy question, but do you have advice for a friend that just started to pay $900 a month for a car? They have bad credit and drive 25 to 30,000 miles a year. I would tell them to lease a Tesla at $300 a month, but the max miles on that is 10K. Oh, for a lease. Gotcha. If they got bad credit, they're kind of fucked. I mean, they can't easily get a Tesla. Maybe they can. Maybe they can get financing. I would think they probably couldn't, and I would think that the rates would still be high. The only benefit for them is that they would save on energy costs. But if they're driving like 25, 30,000 miles, range anxiety could be a thing if they're just doing like long distance trips, if they're going to remote areas. So I don't know in that case, man. They just need to maybe look at it and see, like, is the inconvenience or potential issues with range a concern if they're putting on that many miles a year? Because 30,000 is a lot in a year. So I'm thinking they're like in sales or they're doing long distance driving. As long as their route is clear and they've got like plenty of charging stations, they're probably going to save a lot on charging versus, gas. And if you're somebody like me and you only put like 12, 13,000 miles on a car a year, maybe 15, you do really well because I charge at home. So I'm paying like a third of what a person would pay for gas. And I'm not paying any maintenance because there's just no maintenance with these cars. So I save a ton of money every month, especially with a lower rate locked in. But it just depends on their situation. Bad credit makes it harder. So I don't know. LB, tell them to get an e-bike. Yeah, that's probably a better idea. But I don't think they're going to bike 30,000 miles in a year. All right, let's see here. Yes, Dinesh. All right, so maybe I'm going to stop. Maybe I'll stop here. I'm sorry, I'll talk less next time so that I can get more into people's questions. And again, when I spin up, let's see, Austin, I've been researching semi-mothballed nuclear power plants and following companies that are interested in recommissioning them for data centers. Interesting. All right, so next time I'm going to try and keep up with live comments more. I'm going to try and make my spiel a little bit shorter, since I feel like I wasted a lot of time and I didn't get to enough requests. So tomorrow we'll try and focus on more requests, and I'll be more efficient with my time. Plus, I don't want to just reiterate the same things every day. I want to kind of give things fresh and have different focal points for each day. So tomorrow I'm trying to be more efficient. You guys hold me to it. For today, though, I think I'm done. So you guys get some rest and chill, and we will talk tomorrow. And then also I'm going to have, starting over the next couple of weeks, I'm going to be doing tons of earnings calls for basically everything I hold, and then trying to add in some more just to get a better beat on the economy. So there's going to be a lot of streams coming, a lot. But I'll try and summarize those in the recap in case you missed the others. Anyway, you guys take it easy. Peace out. Talk to you tomorrow.